Okay, in this session, what I want to do is get ready for the second project. I know everyone's focused on paper one, and that's what your focus should be on. So as soon as that paper is done, you can get started on the second project, which is a lot easier than the first paper, to be sure. Let me just outline what this project entails. It's all set up in Excel for you, so it's really just a matter of walking through the process. I want this project to expose you to the basic way we do things in finance. This is not uncommon to see in many companies today. Efficient frontiers, using some value at risk, doing some style analysis, doing some manager attribution. These are all things that are very, very common in an entry-level investment job. So it's good experience to actually do it real life. And at the same time, I want you, while you're doing it, to think, does this make sense? Does this work? To be that skeptical finance person I'm encouraging everyone to be. So let's think about the project. It has a few components that are pretty straightforward. So there's four things essentially, but each one of them is fairly straightforward. The first thing you're going to do is you're going to do an efficient frontier. You're going to have a made-up client, someone you make up. You can build them however you want to. I recommend you have a client come to you who has really bad investment portfolio, so that your recommendation will be a major improvement. It just makes the paper easier to write when you do it that way. The second thing we're going to do is look at historical value at risk, just so you have some exposure to historical value at risk. Very, very simple. It's usually one or two paragraphs of the paper, so it's probably the simplest thing of the four. The third thing is a style analysis. If you've never done a style analysis, this is really, really valuable and really powerful. In fact, you might have a job where your boss has never done a style analysis, and you can volunteer to do it and would actually really impress them that you're able to do that. It's not difficult to do, and you'll see it's all set up for you in Excel. I encourage you, as you're doing these projects, to look at how I have it set up in Excel so that you could do it yourself. And the last one is a manager attribution. So with the manager attribution, we're asking, hey, let's look at this active portfolio manager. Maybe it's a large cap, U.S. large cap stock manager. Maybe it's a U.S. small cap stock manager, or large cap growth manager. Whatever they are, you want to take that manager's returns and do exactly what we talked about on that exam question: peer risk or peer benchmarking risk. We want to look at how this manager is doing versus the benchmark and make an assessment of the return and risk contributions. On the efficient frontier, you're doing this for a client you create. For historical VAR, you're going to do this comparing it to parametric VAR. And again, it's all set up. Style analysis, you're going to do this for a multi-asset class mutual fund. We'll talk about that. These are funds that have words like balanced. Balanced funds are asset allocation funds, or I'll show you some terms. Most firms have these multi-asset class funds, so we're talking about something that has stocks and bonds in it, and probably multi-categories of stocks, multi-categories of bonds. On the manager attribution, you're going to do a single asset class mutual fund. So you might do a large cap growth fund or a small cap value fund, but they only do one thing. It should be in the title of the fund, and I'll show you if you if you go to a site like Vanguard or Fidelity, they'll have their funds listed, and all of their multi-asset class funds will be in one area, and you can look at them, and their single asset class funds will all be classified by asset class, so they will help you with this. So let's think through this project. The way you're thinking about it is a client comes in to you with an asset allocation. you're going to take their allocation and you're going to compare it to the efficient frontier, and you're going to make a recommendation for them to move to a new asset allocation, get better return at the current risk or get the same return at lower risk. Or you might have a young client that's way too conservative. Maybe they have 60% of their money in bonds, and you're going to recommend they go out to 60 or 70% in stocks. Or maybe you have an older client that's too aggressive. Maybe they have 90% of their money in stocks, and you're going to move them to a much more conservative portfolio. You're then going to assess your recommendation using historical data, something that financial planners would never do. You'll see why, because it's almost embarrassing. Because many times our recommendations using parametric value at risk, which is what the efficient frontier does, when you compare the historical numbers, we often find that our recommendations don't look all that great when we look at it versus history. Your client also comes in and says, you know what, I really like this multi-asset class mutual fund. Can I use this fund to implement your recommendations? And just very, very clear, your recommendation will almost always, if not always, be no. You cannot. It's very unlikely you're going to have a multi-class asset class mutual fund, multi-asset class mutual fund that is going to match the asset allocation you are recommending. And then on the manager attribution, your client comes in and says, okay, you're recommending U.S. large cap growth stocks. This is the manager I've been using. Can you just tell me, is this a good manager? How have they done? And there you will essentially be assessing the manager. You're not necessarily going to say that they should change managers. You're definitely not going to try to find a better manager for them. That's just way too much work. There's thousands of mutual funds in there. So you will pick the fund that you use in number 3, and you will pick the fund that you use in number 4. And on number 1, you will define your client, how old they are, what asset allocation they come in with. So I want to walk through this. So all of these are in Excel spreadsheets. So let's start with the first one, the efficient frontier. So here's what the file looks like. It has an overview. So we have the model output. There's an efficient frontier graph. The historical VAR and the style analysis is there, and there's a graph I built for the style analysis. Those are the only ones that you need to do, the efficient frontier graph and the style analysis graph. You'll actually copy and paste those into your paper. I want this entire paper in a Word document. I don't need your Excel file. You'll use Excel to build the numbers and then get your graphs. The model output has a few other graphs that you can use in your paper, some pie charts. The pages at the end, the asset returns, the return assumptions, the risks, the correlations, those last few sheets you don't need to touch. They're just there to build the rest of the presentation or the Excel file. So let's start with the model. So the way the model is structured is it has the assumptions that we need to build an efficient frontier, which are return, risk, and correlation. Those are the 3 things we need. And here are the asset classes that we have. We have U.S. large cap growth. So these are large companies that are growth companies. I'm assuming you've seen the definition of growth and value before. In previous classes, you might Google that and look up Wikipedia or look up Investopedia. But basically, growth companies tend to be stocks that are expensive. They have high price to earnings or high price to book values, but they're growing fast. So something like an Amazon or Alphabet or Facebook, those are fast-growing companies that look expensive. Then you have large companies, the stocks of large companies that are considered value companies. These are companies that look inexpensive, but they're inexpensive probably because they're high risk or they have very low growth. So Macy's looks like a very, very inexpensive company, but that's because the market does not expect much growth from them. Same thing with smaller companies. We have small cap growth, small cap value. We have developed market stocks, so Japan, Germany, Australia, those developed markets. We have emerging market stocks, so China, some countries in Asia, Thailand, countries in Africa, South America, Brazil, those type of countries. We have gold. So gold is a little interesting here. Sometimes when people say gold, they mean the stocks of companies that produce gold. Sometimes when they say gold, they actually mean the gold itself. Here I'm using actual gold. I'm using an exchange-traded fund that does gold. And then we have bonds. These bonds is a generic bond, includes both treasuries and corporates and probably a few other bonds. And then high yield, so these bonds in column I are investment grade, high quality bonds, and in column J is other bonds that are high yield. So they're lower investment quality, so they're below investment grade, they're below triple B. So the most risky of the bonds. So here's all the asset classes you have. We have a return for each of them. In your paper, you do not have to discuss how I got these returns. It is documented in the spreadsheet. If you want to put it in your paper, you can, but it's not required. The risk and the correlations are essentially relying on historical data. I do have some charts that show that and how unstable they are over time, but you don't need to put that into your paper. What you do have to do is acknowledge where you got your assumptions. So you might copy and paste this, you might clean it up some, but copy and paste these assumptions. And you just need to acknowledge that you're using the assumptions as provided by Professor Sweet. Not that I want credit for these assumptions, but anytime you do any efficient frontier or any type of modeling like this, you need to document where the assumptions came from. If you look at the correlations, you can see the stocks. We have large cap versus large cap. So large cap growth versus value, they're very highly correlated. Large cap growth versus small cap growth are highly correlated. When you get down to bonds and gold, you see that there is very low correlation, even negative correlation between these. Again, all of these assumptions are based on history. So the blue is the assumptions. There's no reason to change the assumptions. I would leave them just as they are. No reason to change, especially the correlations. Just leave everything as they are. So that's the blue section. The green section is where you're going to spend your time. Well, I'll talk about that last. And then at the bottom, this yellow or peach section are the calculations. You don't need to do anything with this unless you want to see how to set up an efficient frontier model. I have, with the UTSA Investment Society, I have done classes showing students how to build one of these from scratch. But it's doing exactly the calculations we talked about in class on return. It just takes your weight to each asset class. This has to add up to 100%. So you take the weight times the return, and the sum of those weighted returns is your expected return. On the risk, we're using this formula. The risk of two asset classes is the weight of A squared times the risk of A squared plus the weight of B squared times the risk of B squared plus 2 times the weight A, weight B, risk A, risk B, correlation of A and B. So the first part of this section does the first part of the equation, which is weight A squared plus the risk of A squared. So I do that for each asset class, and I sum all of those up. And then I do the second part of the equation, which is 2 weight A, weight B, risk A, risk B, correlation of A and B. You have to do this somewhat in a pyramid so you have every possible combination. We don't need to do large cap growth to large cap growth, but we do need to do large cap value to large cap growth. Once we do that, we don't have to do it again. We don't need large cap value and large cap growth here. We've already done it there. So you can see how each one of them doing. If you just look at the equation, I'm taking 2 times the weight of the first asset times the risk of the first assets times the weight of the second asset times the risk of the second asset times the correlation of those two assets. That's what this formula is doing. You just sum all those up so you have every possible combination. You can see here we have how many? 9 asset classes. So to do 9 asset classes, it requires us to have 36 different combinations. So it's just the nature of the beast. The more asset classes you add, the more of these combinations there are. This is all the calculations. Again, you don't need the calculations. So we're going to spend our time just in this green section. And what I want to show you in the next video is how to run the model. So let's show you the very first thing you're going to do before we run the model. So go to the model output, and it's already got something set up, so you can't use what's already there. Don't do anything with B2. B2, you can see there's formulas in there. B2 through L, it's just referencing to whatever's on the model page. So just leave that like it is. What you're going to do is whatever's in B2 through L2, you're going to copy and paste them as values down here. So here's where you're going to do your actual calculations. What you want to do is anything in that section, so anything from B5 all the way down through L, you can go down as far, anything that's there, you just want to hit highlight and hit delete. We're going to rebuild all this. The first line is your current portfolio. I'll talk about how to set that up next. What's ever in the green is your recommendation. So you want to make sure what your final recommendation is ends up in the green area. And then off to the right, there's some graphs. The graphs won't show up until you have data. All right. So let me show you the first thing we'll do in the model is I'm going to set up my client and I'm going to set up my constraints. The one thing you have to do is change your constraints. Your constraints must be different than mine. I'm going to leave mine as they are, but you have to change them. So you don't have to, you can change the 10% to 15%, the 40% to 50 or 30. Just think a little bit about it. So high yield, high risk bonds. What's the most you want to put in your portfolio? 5 to 15% is pretty standard. Gold is a very volatile asset class. What's the most you would want your client to have in gold? Typical again for gold is 5 to 15% in gold. Above 15% gold starts taking over the portfolio. Emerging market stocks, what's your constraint there? I've seen constraints as low as 10%, as high as 40%. In the video you watched for the last class and the Maciel video, he had 17% as his recommended allocation for emerging markets. This is not your recommended allocations. This is what your max, the most you want to do. And then international stocks. If you want to add emerging markets and developed market stocks together, what's the most you would have there? I've seen anything as low as 30%, anything as high as 60%. Not as the allocation itself, but as the constraint. So these are constraints. So change at least one of these numbers. And then what you're going to do is you're going to define your company, your client. So you just need to put some numbers in here. And what I recommend you do is come in with something that's really unallocated, poorly allocated. But I recommend you not do something that violates your constraints. All right. So if your constraint says the max you can have is high yield is 10%, don't put 20% in high yield for your client. It causes some problems if you do that. So I'm going to put 70% in high yield and large cap growth. And I'm going to put 30% in bonds. That's going to be my client. So once you key those numbers in, make sure they add up to 100%. And then you go to the model output. And so right there is your client's portfolio. You need to highlight those cells. So just click on the first one, Shift, Control, and the right arrow. Then right click, and you want to copy that. And make sure when you come down to row 5, don't hit enter, hit your right click and hit this 1, 2, 3. We want to paste these as values. You don't want them to be formulas. All right. I'm going to stop it there. And then what we'll do next, I'll go back to the model and we're going to start building the efficient frontier point by point by point. So if you're staying right with me, save your file, and in the next video I'll show you how to build the efficient frontier.